Let's be real for a second. If your money is just sitting in a bank account, it is literally losing value every single day. And as we head into 2025, that's a reality none of us can afford to ignore. So in this explainer, we're going to lay out the exact blueprint to turn that around, to put your money to work, and to start building real, lasting wealth for your future. Let's dive in. And that right there, that's the silent thief that's emptying your bank account. It's called inflation. And look, this isn't some high-level abstract economic concept we're talking about. No, it's the very real reason your groceries cost more and your savings buy you less and less every single year. If your money is just sitting there, it's going backwards. So that's the million-dollar question, isn't it? The truth is, you just can't save your way to wealth anymore. It doesn't work. You have to put your money to work. You have to invest. And right here, right now, we're going to show you exactly how to get started step by simple step. Okay, so here's the game plan. We're going to start with the absolute essentials, building your financial foundations. Then we'll get into the smartest strategy for anyone just starting out, how to choose the right investment accounts, and crucially, we'll cover the common traps you absolutely need to avoid. First things first. Think about it. You wouldn't build a house on shaky ground, right? Of course not. Well, the exact same principle applies to your financial future. Before you even think about investing a single euro, you've got to build a rock-solid foundation. Okay, here's the most important part, so listen up. Paying off a credit card that's charging you, say, 8% interest, that is the exact same thing as earning a guaranteed, totally risk-free 8% return on your money. Where else are you going to get that? Nowhere. Tackling this kind of debt isn't just a smart move, it is the single best investment you can possibly make, period. So, how do you actually attack that debt? Well, there are two popular strategies. With the snowball method, you pay off your smallest debts first. This gives you these quick, motivating wins that build momentum. On the other hand, the avalanche method has you focus on the debt with the highest interest rate. Mathematically, it's the fastest way and saves you the most money. So which one's better? Honestly, the one you'll actually stick to. All right, once you've slayed those high-interest debts, it's time to build your fortress, your safety net. This is the oh crap fund that protects you from life surprises. With sudden car repair, an unexpected bill. This is what keeps you from having to sell your investments at the absolute worst possible moment just to cover an emergency. So what's the magic number? It's pretty simple, actually. Just add up your essential monthly expenses. We're talking rent, food, utilities, the absolute must-pays. Your goal is to have 3 times that amount saved up in a separate, easy-to-access account. So if your essentials cost 1,500 euros a month, your target is 4,500 euros. That's your financial firewall. Okay, foundation's built, it's solid. Now for the exciting part, actually building some wealth. Let's get into the single best investing strategy for beginners and how you can avoid a very common and very painful rookie mistake. And this isn't a hypothetical, this is a real story. Back in 2008, Nokia was a giant, bigger than Apple is today. It seemed like the safest bet on the planet. But trying to pick individual winning stocks, even ones that look like a sure thing, is just incredibly risky. The history of the stock market is littered with the tombstones of companies that were sure things. So, how do you avoid falling into that same trap? The answer is something called an ETF, or an exchange-traded fund. Think of it like this. Instead of searching for one single golden needle in a massive haystack, what if you could just buy the entire haystack? That's pretty much what an ETF lets you do. With one single purchase, you own a tiny piece of the whole market. Now, here's why ETFs are so powerful, especially when you're starting out. First off, the fees are ridiculously low. We're talking like 0.1 or 0.2%. That means more of your money stays working for you. Second, you get maximum diversification, like instantly. If one company goes belly up, who cares? It's a tiny little blip because you own hundreds of others. And third, it's basically hands-off. It's passive. The fund manages itself. All right, so we've figured out the what. You're going to invest in ETFs. But now for the where. And trust me, the account you use, the envelope you put your investments in, is just as important as what's inside it. It can make a huge difference to your taxes and how much you actually keep in the long run. Okay, so for investors in France, this is the big matchup. It's the PEA versus the Assurance V. And as you can see, they each have their own superpowers when it comes to things like taxes, flexibility, inheritance, and fees. So let's dig into which one is right for you. Here's a simple rule of thumb. The PEA is your best friend for long-term investing. The killer feature? After just 5 years, your profits are pretty much tax-free. You just pay the social charges. It's incredibly efficient for growing wealth over many years, especially with stocks and ETFs. Now, on the other side of the ring, you've got the assurance fee. And if the PEA is all about long-term growth, the assurance fee is the undisputed champion of flexibility. You can get to your money more easily, you can invest in super safe funds called fonds, and on top of all that, it's a fantastic tool if passing on your wealth to family is a big priority for you. It's a real powerhouse. All right, you can have the perfect strategy, the perfect account, the whole shebang, but if you don't master this next part, none of it matters. We're talking about your own brain, your psychology as an investor. This is what separates the winners from everyone else. Just let that sink in for a second. Over 20 years, just 10 days made up half of all the gains. This is exactly why trying to time the market, jumping in and out trying to buy low and sell high, is a total loser's game. You're almost guaranteed to miss those key days. The secret to winning isn't timing the market, it's time in the market. And speaking of trying to time the market, please, whatever you do, stay away from the siren song of day trading. The data on this is brutal, and it's not up for debate. A study by the French market authorities found that almost 9 out of 10 people who try it lose money. Full stop. It's stressful, it's a ton of work, and it's a fast way to lose your hard-earned cash. So what's the solution? How do you protect your portfolio from your own worst enemy? Which, let's be honest, is usually yourself. It's simple. You take emotion completely out of the equation. You put it on autopilot. You automate. Just set up a regular automatic investment every single month. It ensures you keep investing whether the market is up, down, or sideways. Okay, let's bring it all home. Here is your entire action plan boiled down to 4 simple, straightforward steps. Number 1, build that solid foundation. Kill the debt, build the savings. Number 2, open the right account for your goals, like a PA or an assurance fee. 3, invest simply in a broad, diversified world ETF. And number 4, the secret sauce. Automate everything. Make discipline your default setting. And there you have it. You've got the blueprint. You understand the why, the what, and the how. You have a clear, effective path to follow. So the question is no longer what to do. You have the plan. The only question left is, when are you going to start? Thanks so much for watching. Now, go put your money to work.